Welcome back to the channel, traders. In today's video, we're going to break down the US dollar index, DXY, using the 3-month chart. This is a higher time frame analysis that gives us a big picture view of where the dollar has been and where it's likely headed next. We'll look at historical price behavior going back to the 1970s, identify the major range that has been in place since 1987, and map out what the current price action is suggesting for the months ahead. First, let's zoom out. This chart covers more than 50 years of the DXY. What stands out is that since 1987, price has been locked inside a major horizontal range between approximately 80.40 support and approximately 102.96 resistance. Every time price gets to the bottom of this range, buyers step in. And when it reaches the top, sellers take control. This has created a massive sideways structure spanning decades. This kind of structure is powerful because breakouts on the 3-month chart don't happen often. When they do, they tend to trap traders. Throughout this range, we've had multiple false breakouts both above and below. Below the range, whenever price has dipped below that 80.40 zone, it has turned out to be a trap. Price quickly recovered and rallied back up to the range resistance. These were classic bear traps. Above the range, we've also seen breakouts above 102.96, but these moves failed to sustain, leading to sharp reversals back down into the range. You can see two highlighted red boxes on the chart, one around the early 2000s and another in the recent 2022 to 2024 zone. In both cases, price broke above resistance, trapped breakout buyers, and then dumped back toward the range support. These fakeouts are extremely important for macro traders. They reveal where liquidity is resting and how institutions trap breakout traders. Now, let's focus on the current structure. Recently, DXY broke above the 102.96 resistance again, triggering excitement among dollar bulls. But the follow-through never came. Price stalled, failed to close convincingly higher on the 3-month chart, and has now broken back below the range high. This kind of move historically has signaled a major top in the DXY. We're seeing very similar behavior to the previous false breakout patterns. The rejection from the resistance zone is clean, and now momentum is pointing down. Given this structure, the logical expectation is a retest of the lower boundary of the range around 80.40. If history repeats itself, price will likely trend lower over the next several quarters, gradually working its way down to that range support. Of course, this is a macro time frame, so these moves can take months to unfold. But the direction is clear. Failed breakout above plus rejection equals bearish bias toward the lower end of the range. Unless we see a strong close and follow-through above 102.96, something we haven't seen in decades, the path of least resistance is down. To summarize, DXY has been ranging between 80 and 103 since 1987. Every false breakout below has led to bullish reversals back to resistance. Every breakout above has eventually failed, leading to sharp drops. Right now, we've seen another false breakout above, and history suggests we're heading lower toward the range support again. This is powerful context for anyone trading USD pairs, commodities, or risk assets. If you found this breakdown useful, drop a like. Subscribe for more macro analysis, and let me know in the comments what you think DXY will do next.